Hello again. We've had the pleasure of assisting many of you for years. Others are newer clients. There are various reasons why you've reached out to us for assistance. One topic that comes up in meetings in retirement planning is financial security. Specifically, many ask the question, will I have enough money during retirement? Situations will vary among families, and that's why we never employ a cookie cutter approach. Each plan must have an individual element to it, but the plans are guided by time tested principles. Consider this: a top rated professional quarterback, his team, and their coaches tailor a game plan for each opponent they face. However, the plans are guided by the basics, the fundamentals. As you look forward to retirement, let's touch on these various fundamentals and what you may want to consider in approaching them. Number one, am I saving enough in my retirement plan or 401k? Is there a matching provision that your company provides? If there is, don't pass up free money. I can't stress this enough because too many people leave cash on the company table. At a minimum, pick up the low hanging fruit. We may have discussed how much is needed to hit your goals, but if questions are beginning to arise or you have concerns, let's talk. Do I have enough or too much in stocks? That's a common question tossed around often by financial professionals. For those who experienced the market declines of 2001 and 2008, there is a nagging fear that we will get battered again. Believe me, I understand your concerns. It's why I preach diversification within and across asset classes to help manage risk. Historically, stocks have outperformed bonds or CDs over the long term, but I recognize a portfolio that is 100% in stocks is too risky for most individuals. You won't squeeze every last dime out of a bull market, but you don't need to. I want to be sure you sleep soundly when the inevitable decline in stocks occurs. Now let me rephrase the question. Is it time to rebalance your portfolio? Given solid gains over the last year, some of you may be too heavy in stocks. It may actually be time to take some of the risk off the table and get you back within your proper parameters. Number three, when should I take Social Security? That's a question that comes up very often. You can take Social Security when you turn 62, or you can delay it until you reach 70. Full retirement ages range from 65 to 67, but beginning at age 62, there's an 8% annual increase roughly for every year you delay filing. Many factors may influence your timing, but it's best to avoid the temptation of filing too early. Moreover, your spouse may receive a higher survivor's benefit by waiting. So I can't cover all the options now, but if you're considering taking Social Security, let's talk and see what might be the best strategy for you. Number four, do you have a pension? How should you take it? Many prefer the peace of mind of a monthly check that comes in on top of your Social Security and savings. Or you may choose a lump sum payment and roll it into an IRA. You may want to choose a joint and survivor annuity. There are other options we can discuss, including life insurance, but my aim is to educate and to get you thinking about the various choices you may have. If you're being presented with various pension options and aren't sure how to proceed, let's talk. Now let's switch gears to the 3% GDP growth. How does that make you feel? The second quarter gross domestic product, which is the largest measure of economic activity, was just revised upward by the U.S. Bureau of Economic Activity from the initial reading of 2.6% to 3%, which is up from 1.2% in Q1. The upward revision leads directly into the highlights of an August 30th CNBC interview with Warren Buffett that I happened to come across. The legendary investor was asked, "Does this feel like a 3% GDP economy to you?" Buffett didn't miss a beat. No, it's been about 2% per year now since the fall of '09. While he also pointed out that long-term growth of 2% is not bad, he maintained that it just doesn't feel like a 3% economy. One quarter just isn't enough to sway sentiment. No doubt the improvement is welcome, and recent reports do suggest the economy is on firmer footing. The jobless rate stands at 4.4%, and job creation has been respectable using data from the U.S. Bureau of Labor and Statistics. Now, job openings stand at a record high, and weekly first-time claims for unemployment still remain at unusually low levels. However, upbeat conditions have not spread evenly to every industry, and wages have yet to turn significantly higher. But favorable numbers are supporting consumer confidence. According to the Wall Street Journal, and as of August 31st of 2017, the Dow Jones is up 11.1% and the S&P 500 is up 10.4% year to date. There are some potholes I'm watching out for. September has historically been the worst performing month for stocks. It's unclear exactly why that happens, and it doesn't necessarily mean there will be problems, but here are three things that I'm monitoring currently. Number one, North Korea. It is yet to significantly impact stocks, but what's happening in Asia is unsettling and could create temporary dips in the market. Number two, a government shutdown. We may see one October 1st. Historically, government shutdowns may create a few bumps as the short-term traders react to headlines, but longer term, the 18 shutdowns since 1976 have had virtually no impact on shares. Number three, breaching the debt ceiling. The Treasury will run out of authority to borrow likely in early October. In the unlikely event Congress fails to raise the debt ceiling, we would sail into uncharted financial waters. If we tiptoe up to the deadline, expect uncertainty to rise. While forecasting market surprises can be dicey, remember that longer-term stocks react to the economic fundamentals, which are aligned with the plan we've recommended for you. I hope you found this review to be informative. If you have additional questions about this month's update, or you would like to talk about any other matters, please feel free to reach out via email or phone. We're always thrilled to hear from you, and as always, we're honored and humbled that you have given us the opportunity to serve as your financial advisors.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results.